When you buy a stock, who exactly gets your money? The company or another investor? Most people buying stocks today have no idea, and this single misunderstanding is why the terms like IPO, stock exchange, primary market, and secondary market confuse so many beginners. But in the next few minutes, you will finally understand how money really flows in the stock market and why smart investors knows the difference. Think of the stock market like a giant shopping system, but there are actually two different markets inside it. One is where companies raise money for the first time, then the other is where investors buy and sell shares every single day. If you don't understand the difference, investing can become confusing very quickly. Let's begin with the primary market. This is where shares are sold for the first time ever. Imagine a company wants to expand its business. Maybe they want to buy factory or build factories, create products, or decide to grow internationally. To raise this money, the company decides to sell some ownership to the public. This process is called IPO, Initial Public Offering. And here's the important part. In the primary market, the money goes directly to the company. So when an investors buy during an IPO, they are helping fund the company itself. That's why primary market is mainly about raising capital. To understand this easily, let's use an example. Imagine a company produced a brand new shoe and you bought directly from them. That's like a primary market. The company receives the money directly, but if another person later sells that shoe to you, that company no longer gets the money. That's exactly how the secondary market works. Now let's talk about the secondary market. This is where investors trade shares among themselves after the IPO. Once shares enter the stock exchange, investor can buy and sell them anytime the market is open. Notice something important here. The company is not receiving money anymore. The money is simply moving between investors. This is where stock exchange comes in, like the Nigerian Stock Exchange, the New York Stock Exchange. Every day, billions of dollars move through secondary markets around the world, and the price keeps moving up and down. You may be wondering, why does the stock market price changes every minute? You can check out my previous video where I explained the reason why stock price fluctuates every minute. So let's simplify everything. The difference between primary market and secondary market. In the primary market, shares are created, companies raise money, and that's where IPO take place. And also, investors buy directly from the company. But in the secondary market, investors trade shares. Price moves constantly. Buyers and sellers interact daily. And here is something many beginners don't realize. Without the primary market, company won't easily raise money from the public. And without the secondary market, investors will struggle to sell their shares later. Both markets work together. That's why the two markets are extremely important for economic growth. One common mistake beginners make is entering into the secondary market without understanding how stock actually works. They follow hype and they panic when it crashes and invest emotionally instead of logically. Smart investors learn first, then invest wisely. Let's wrap it up. When you hear the word IPO, remember that's the primary market. And when investors buy and sell shares daily on the stock exchange, know that that is a secondary market. Now you understand the system most beginners ignore. If this video helped you understand investing better, subscribe for more simple finance lessons. And comment below, will you rather invest during an IPO or buy later in the secondary market, or do both?